Investing might seem complicated, but the first lesson John Bogle teaches is surprisingly simple. Most investors fail not because they are unskilled, but because they act against their own best interests. To explain this, Bogle uses a story, a parable, that illustrates the key principles of successful investing. Imagine two investors. One is patient, disciplined, and focused on the long term. The other is constantly chasing the latest trends, buying hot stocks, and selling during every market dip. Over time, the disciplined investor consistently wins, while the trend chaser often loses. Why? The costs of trading, fees, taxes, and poor timing slowly eat away at returns. This is what Bogle calls turning a winner's game into a loser's game. The market itself, over decades, produces growth, but most investors sabotage themselves. For example, suppose you invest $10,000 in a broad market index fund with an average annual return of 8%. After 30 years, it grows to about $100,000. But if you frequently buy and sell, paying fees and taxes that reduce returns by even 1 to 2% a year, your $10,000 might only grow to $75,000. That's the power of compounding, working for you or against you. The parable also teaches patience. The best returns don't come from winning big in a short time, but from staying invested consistently. Bogle stresses that speculation, timing, and chasing trends rarely beat simply owning a broad slice of the market. The story makes it clear, investing isn't about being clever. It's about being consistent, disciplined, and aware of costs. In short, the stage for the entire book. Success comes not from picking the right stock, but from following a strategy that captures the long-term growth of the market while minimizing costs and mistakes. This simple idea, buy, hold, and minimize costs, forms the backbone of Bogle's philosophy, and it's what every investor should understand before putting money in the market. John Bogle explains how the stock market really creates wealth over time and why investors should focus on long-term growth rather than short-term excitement. He calls it rational exuberance because markets can rise, but the gains come from real business growth, not from speculation or hype. Understanding this helps investors keep perspective when prices swing wildly. Bogle emphasizes that stock returns come from three main sources: dividends, earnings growth, and changes in market valuation. Dividends are the cash companies pay to shareholders, often steadily increasing over time. Earnings growth reflects the real expansion of businesses as they sell more, innovate, or become more efficient. Finally, changes in valuation occur when the market decides to pay more or less for a share relative to its earnings. While this last part can be unpredictable, the first two are steady and reliable drivers of long-term returns. For example, imagine you own shares in a company that pays a 2% annual dividend and grows its earnings by 6% each year. Even if the stock price fluctuates over time, your investment increases steadily because the company is growing and returning profits to shareholders. Investors who try to time these short-term price movements often miss the benefits of consistent growth. Bogle warns against being seduced by market hype or get-rich-quick stories. Many investors see a stock soaring and rush to buy, only to sell in panic when it drops. This behavior reduces long-term wealth because they are reacting emotionally, not following a rational plan. True wealth comes from staying invested in a diversified portfolio that captures the overall growth of the market. This reinforces the idea that investing is about capturing the returns of businesses over decades, not trying to outguess the market. Rational exuberance means understanding the fundamentals and being patient, disciplined, and cost-conscious. By focusing on what really drives returns, dividends, and earnings growth, investors can avoid unnecessary risks and steadily build wealth over time. John Bogle emphasizes that investing is fundamentally about owning pieces of real businesses, not gambling on stock price movements. He calls this casting your lot with business, aligning your money with the growth and success of companies over time. The stock market is just a tool to participate in the profits and growth of businesses, and understanding this changes how you approach investing. Bogle explains that every share you buy represents a small ownership stake in a company. When the business grows, earns profits, and pays dividends, you benefit. Over decades, owning a diversified slice of many businesses allows your wealth to grow steadily, regardless of short-term market fluctuations. Speculation, on the other hand, focuses on predicting price movements, which is unpredictable and risky. For example, imagine investing $10,000 across 500 companies in a total market index fund. Even if some companies fail, most continue to grow, pay dividends, and increase in value. Over 20 or 30 years, your investment mirrors the overall economy's growth. Contrast this with someone who tries to pick the hot stock each year. While a few winners may occur, frequent trading and poor timing often reduce net returns. Bogle also points out that stock market swings can be emotional traps. Investors see prices rise and fall, and often buy at the top or sell at the bottom. By focusing on business fundamentals, profits, productivity, and dividends, rather than daily price changes, you avoid these pitfalls. True wealth comes from participating in the real economy, not chasing speculative trends. The key takeaway is that investing is not about being clever, but about being part of business growth. Buy broad-based index funds that represent many businesses, stay patient, and let the company's earnings and dividends compound over time. This approach keeps you aligned with reality, reduces risk, and ensures that your long-term returns reflect the real growth of the economy. In Chapter 4, John Bogle explains why most investors fail to achieve the returns the market offers, even though investing in broad-based stocks is theoretically a winner's game. The market itself tends to grow over decades, but individual behavior often turns this natural advantage into losses. Bogle identifies the main reasons: high costs, taxes, and poor timing. Frequent trading, chasing hot stocks or funds, and reacting emotionally to market swings dramatically reduce net returns. Even if the market grows at an average of 8% per year, fees, taxes, and impulsive decisions can cut the investor's gains by 1 to 2% annually, which compounds into a huge difference over decades. Bogle emphasizes that costs are the silent killer. Management fees, trading commissions, and fund expenses might seem minor in the short term, but they compound against investors like interest on a loan. Taxes also chip away at returns, particularly for short-term trades or frequent fund switches. John Bogle emphasizes one of the most important lessons for long-term investors. Costs matter more than most people realize. Even small differences in fund fees, trading costs, or taxes can have a huge impact over decades. This is why focusing on low-cost funds, particularly index funds, is central to his investment philosophy. Bogle explains that many investors ignore the hidden costs of investing. Mutual funds charge expense ratios that reduce returns year after year, often without the investor noticing. For example, a fund with a 2% annual expense ratio might not sound like much, but over 30 years, it can wipe out almost half of your potential gains compared to a 0.1% index fund. Compounding works against you when costs are high. Taxes and trading fees add another layer of cost. Frequent buying and selling may generate short-term capital gains, which are taxed at higher rates. Each trade and tax payment chips away at your overall wealth. By contrast, low-cost index funds typically have low turnover, which reduces both fees and taxable events. Bogle's advice is clear. Never underestimate the impact of cost on long-term returns. Choosing a fund should start with its expense ratio. Index funds, by design, minimize costs because they simply track the market instead of paying managers to try to beat it. The key takeaway to keep costs as low as possible and let the market's growth work for you. No clever timing, stock picking, or hype can overcome high fees over decades. If there's one rule every investor remembers from Bogle, it's this: the lowest cost funds give you the best chance of achieving your financial goals. Bogle reveals a hard truth. Most actively managed mutual funds rarely outperform the market over the long term. He calls it the mutual fund mirage because investors are often misled by short-term gains and flashy advertising, thinking they can beat the market when, in reality, very few consistently do. Bogle explains that mutual funds appear attractive because they often highlight their recent outperformance. A fund may outperform the S&P 500 for a year or two, which grabs headlines. But history shows that sustaining this over decades is extremely rare. When you account for fees, trading costs, and taxes, the returns of most actively managed funds fall below those of low-cost index funds. For example, imagine two investors in 2000. One chooses a hot tech-focused mutual fund, lured by high returns from the past 2 years. The other invests in a broad market index fund. Over the next decade, the tech fund collapses during the dot-com crash, while the index fund, despite short-term volatility, steadily grows along with the overall market. The mirage of short-term success disappears. Bogle also highlights survivorship bias, a common marketing tactic. Funds that perform poorly are often closed or merged, while successful ones are heavily promoted. This makes it look like more funds beat the market than actually do. Investors see only the winners and think it's easy to pick them, which is misleading. By investing in an index fund, you automatically own a piece of the entire market, capturing the average returns of all companies rather than gambling on a few managers' predictions. Over decades, this simple approach consistently outperforms the majority of actively managed funds. Bogle explains one of the most powerful principles of investing: buy and hold. Instead of trying to time the market or chase hot stocks, investors can achieve steady long-term growth by simply holding a diversified portfolio of index funds. Patience, not cleverness, is the key to wealth accumulation. Bogle emphasizes that stock prices fluctuate daily, sometimes dramatically, but the underlying businesses continue to grow. By staying invested, you participate in that growth without being distracted by short-term market noise. Selling during a downturn can lock in losses, while staying invested allows compounding to work its magic. For example, imagine investing $10,000 in a broad market index fund and holding it for 30 years. Even if the market experiences recessions or crashes along the way, your investment steadily grows. fueled by dividends and earnings. On the other hand, if you panic during a downturn and sell, you might miss the recovery, significantly reducing your overall return. Historical data shows that the vast majority of the market's growth occurs in relatively few up days. Missing just these days can drastically harm your long-term results. Bogle also notes that buy and hold works best when combined with low-cost funds. High-cost funds erode gains, especially when combined with frequent trading. An index fund held over decades with dividends reinvested benefits fully from compounding, giving you a much higher probability of reaching your financial goals. Bogle explains the importance of rebalancing your portfolio to maintain your desired risk level and investment strategy over time. While buying and holding is essential, market fluctuations can change the mix of assets in your portfolio, making it riskier or more conservative than intended. Rebalancing keeps your investments aligned with your goals. Bogle emphasizes that different asset classes, stocks, bonds, and cash, move at different speeds. For example, during a strong stock market rally, your stock allocation may grow from 60% to 70% of your portfolio, while bonds shrink to 30%. This increases your portfolio's risk because stocks are more volatile. Rebalancing involves selling a portion of your stocks and buying bonds to restore the original 60-40 mix. Rebalancing also helps control emotions. Without it, investors may become overconfident during market booms or fearful during downturns. A fixed strategy ensures you stay disciplined, minimizing the temptation to chase trends or panic sell. Bogle stresses that rebalancing should be done periodically, not obsessively. Annual or semi-annual reviews are sufficient for most investors, avoiding excessive trading costs while keeping the portfolio on track. Combining this with low-cost index funds ensures that you benefit from the market's growth while controlling risk. The key is rebalancing maintains your intended risk and maximizes long-term growth. It's a simple, practical strategy that complements buy and hold investing, helping you stay disciplined, reduce risk, and keep your investment plan aligned with your financial goals. Bogle introduces the concept of asset allocation, which is deciding how to divide your investments among different asset classes like stocks, bonds, and cash. He emphasizes that how you allocate your money has a bigger impact on your long-term returns and risk than trying to pick individual stocks or time the market. Asset allocation is the blueprint that guides your portfolio through good and bad market cycles. Bogle explains that stocks offer growth but can be volatile, while bonds are more stable but produce lower returns. Cash is safe but usually loses purchasing power over time. The key is to find a mix that matches your goals, time horizon, and risk tolerance. For example, younger investors can afford more stocks because they have time to ride out market swings, while those nearing retirement might favor bonds to preserve capital. A common rule Bogle mentions is the 100 minus age guideline. Subtract your age from 100 to determine the percentage of your portfolio in stocks, with the remainder in bonds. For instance, a 30-year-old would hold roughly 70% stocks and 30% bonds. This is not a rigid rule, but a simple way to balance growth and risk. Rebalancing complements asset allocation. If stocks outperform bonds, your portfolio may become riskier than intended. Regularly rebalancing, selling some stocks and buying bonds, keeps your allocation aligned with your plan. This disciplined approach reduces emotional investing, such as panic selling during downturns or chasing hot sectors. Bogle focuses on retirement investing, explaining how to structure your portfolio and strategy to secure long-term financial independence. Retirement planning isn't about chasing quick profits. It's about steady, disciplined investing that takes advantage of time, compounding, and low costs. Bogle stresses that the most effective retirement strategy starts with maximizing contributions to tax-advantaged accounts like 401ks, IRAs, or Roth IRAs. These accounts allow your investments to grow without being immediately taxed, which significantly boosts long-term returns. Even small, consistent contributions add up over decades thanks to compounding. For example, imagine contributing $500 monthly to a low-cost S&P 500 index fund for 30 years. At an average 8% annual return, your contributions could grow to over $500,000. Taxes, fees, or sporadic investing could drastically reduce this amount. The key is consistency, low costs, and long-term discipline. Bogle also emphasizes the importance of keeping your retirement portfolio simple and diversified. A mix of stocks for growth and bonds for stability provides both returns and protection against market volatility. Younger investors can focus more on stocks to maximize growth, gradually shifting toward bonds as retirement approaches to preserve capital. Another strategy is automatic investing. Setting up automatic contributions ensures you stay on track without letting emotions dictate decisions. This prevents the common mistakes of market timing, panic selling, or skipping investments during downturns. Over time, the market's growth and reinvested dividends compound into a secure retirement fund. Finally, Bogle reminds investors to ignore hype and focus on fundamentals. You don't need exotic strategies or complicated products. Low-cost index funds, consistent contributions, and proper allocation are sufficient to build a solid retirement portfolio. Bogle reminds us that the market grows over time. Instead of chasing short-term gains, investors should focus on owning a broad slice of the market through low-cost index funds. Costs matter more than most people realize. Even a 1 to 2% difference in fees can reduce long-term wealth by tens of thousands of dollars. By keeping costs low, you let compounding work in your favor. Diversification is another pillar. Owning many companies across industries, countries, and asset classes reduces risk and smooths returns. Bogle also stresses discipline. Stay invested, avoid panic selling during market drops, and don't get lured by hype or hot tips. Behavior matters more than cleverness. For example, imagine two investors over 30 years. Investor A follows Bogle's principles, invests consistently in low-cost index funds, stays diversified, and ignores market noise. Investor B chases trends, trades frequently, and pays higher fees. Investor A ends up with significantly higher returns simply by following a simple, disciplined plan. Bogle also ties in asset allocation and rebalancing. Maintaining the right mix of stocks and bonds based on age and risk tolerance, and rebalancing periodically ensures your portfolio grows steadily without taking unnecessary risks. Retirement investing follows the same logic. Contribute consistently, use tax-advantaged accounts, and focus on long-term growth. The core message is simple. Simplicity works, complexity doesn't. By combining low costs, diversification, patience, and disciplined behavior, anyone can participate in the market's growth and build lasting wealth. Bogle's principles have endured because they are based on reality, not speculation or marketing gimmicks. So remember, keep it simple, stay disciplined, minimize costs, and let the market do the work for you. Follow these rules and you'll be investing with common sense, not emotion. If you found this summary helpful, like, comment, and subscribe for more audiobook summaries and investing tips.